Welcome to a very important discussion on venture capital in Africa. We are going to demystify the topic of venture capital. We'll break it down, sort of what does that mean? What is private funding? This group, in terms of the audience, is a mixture of new entrepreneurs, new investors, and also seasoned. So we're going to sort of speak in the middle to both folks, and we hope to give you all an energy as we go into the 2023 year on a very important topic. My name is Sunga Nkwezalamba. I'm a Malawi born. I was born in Malawi, raised in the US. I'm a lawyer by training. So I'm also a co-founder of Stradford Venture Partners. We focus on early and seed stage companies in clean tech, fintech, and pharma. Hopefully we'll get a chance to break this down. Later, we are partnering with Kuza Initiative for this event. Kuza Initiative is a Kenyan-based group of young policymakers, innovators, entrepreneurs, legislators, auditors, and parasitals. Kuza is the founder of Data Analytics Kenya and works with the ISACA Kenya chapter in its initiatives. We were introduced to Kuza through one of our associates, Immaculate. And I will say that I'm very impressed with the group. They've done a great job in mobilizing resources and putting together a great event for us. And we're working through a series where this will be our introductory to the topic, and then we'll continue forward by introducing the audience to more parts of venture capital and private funding in Africa. So do stay with us and pace with us. I think it's going to be a great learning journey for everyone. Stratford is also as an investment firm, is going through the process of raising funds to deploy into startups in Africa. So if you are an investor or someone interested in African markets, please do feel free to reach out to me or any member of our team. You can find us at stratfordventurepartners.com. That's stratfordventurepartners.com. All right, so pretty excited about the panel today. We've got some can I say veterans, seasoned veterans in the investment space in Africa, Marshall Wolf and Igosa Omiyogi. I hope I said that correct, Igosa. I'm Malawian, I'm not Nigerian. Please don't kill me.
That's fine.
Yeah. Marsha is an early stage tech venture investor and business mentor. She's lived and worked internationally, including in Uganda, Nigeria, and other parts of Africa. Since 1997, she has been a private equity and social impact investor, focused on African business development via joint ventures, global trade, private financing, and grant funding. Marsha has vetted thousands of venture deals and co-founded several investor networks. And then we have Gosa, who is a fellow lawyer. He is the founder and managing partner of Echo VC Partners, a seed and early stage technology venture capital firm investing in underrepresented founders and underserved emerging markets. Igosa was personally responsible for developing and sourcing investment opportunities in various popular tech companies, including Facebook, LinkedIn, and Pandora. And because it was on your public bio, I included this. Igosa collects colognes and has a fondness of big dogs and loves football and cricket.
Because I'm going to send you some of the Christmas presents for my husband. He's not into collecting those things.
That's funny.
You'll be impressed, though. You're nice.
Always up for it. Always up for it.
So diving into the topic, I think for the audience members, we have folks from all over the globe: London, Chicago, New York, Lagos, places in Kenya, Malawi, of course. A lot of them are interested in this topic of venture capital funding. You know, we received a huge amount of interest. So sort of breaking it down, Igosa, do you mind talking about like what is venture capital for you and how are you investing at what stages?
Sure. Thanks for having me. And I appreciate being here to share a little bit about sort of what I've learned along the way, and hopefully I can impart some of those learnings to folks. So venture capital is one type of financing available to what we would call startups, or in another construct called sort of the small and medium-sized enterprise, right? And what makes venture capital different from other types of financing products is that it tends to be the best fit for high growth companies. And high growth companies in this case tend to be technology driven, not exclusively, but technology driven. They can be commerce, they can be tech, they can be a lot of different things. But the one thing that they're very, that drives the attractant for VC, venture capital, is that they grow very, very quickly. And so because they grow very quickly, they need, large, increasingly larger amounts of financing to fuel and fund that growth. So we make, and by the way, and venture capital is sort of divvied up into stages, really depending on the life stage or life cycle stage of the company. So at the very beginning, you've got financing that's called pre-seed and seed. And that is sort of essentially what it sounds like what it is, which is, you put some seeds in the soil, you till the soil, put some water, put some fertilizer, and, and hopefully things start to germinate and from there grow. And then once they start to germinate and grow, you put some early stage money in, and then, the thing becomes sort of a small tree, you put in some mid-stage money, it becomes a slightly larger tree, you put some growth stage money. So these venture capital infusions are tied into the various life cycle stages of the company. And I apologize if some of you already know this, but I just want to make sure that we can sort of normalize the conversation. And so for us, we do seed at early stage. And what that means is that we're taking very, very early risk on the company and its founding team. And we do technology and technology enabled companies. And so that, spans the essentially you can do everything from health tech to ed tech to pure software, to e-commerce, to mobility. So there's a real wide span. Now, what we don't do is solar tech. And that's specifically because we don't feel that the types of investment checks we write are a good fit for solar, which tends to be quite heavy in terms of its sort of requirements for financing. So we think that's more of a private equity type of thing. So we stay away from solar, but everything else in software, technology, and technology-enabled opportunities, that's what we invest in.
No, that's super helpful, and thanks for the background. I think for the folks who are new to the conversation here, it's great to have that learning, and for those who might be seasoned, it's a great refresher. I think one thing that stood out to me was like risk, right? I think we're in a space when you invest early in a company and there's no public oversight, or like in the public markets, there's a lot of risk. So Marcia, a lot of people might be asking or thinking about, why Africa, especially those who are joining us from the US, and they might think that this is something that maybe you could speak on, right? Like you have experience as someone who moved and lived in Africa, et cetera. So you've seen outside and inside. Why venture capital in Africa for you?
Because I'm contrarian. In a word, yeah. If you follow the herd, you can expect to get whiplash and be very disappointed if you go after what used to be the greatest and best. So I like to be in the next thing before it becomes a thing. And my, well, I don't need to get into my background, but Africa was clearly, not developing at the rates that Asia was. And as I worked with diaspora of all of those continents, I recognized that Africa was lagging. So when I saw what the Asians went through, I took notes and this wrote a thesis on how China's economic development was funded, et cetera. And I was working on getting the right teams to work with in Africa during that whole time. And then I got wrapped up in a corporate joint venture that really highlighted to me that Africans' own entrepreneurs were raring to go, and all they lacked was the support. And they knew what the problems were, how to address it in the market, and so I got to work on Africa specifically, 1997-ish, and started realizing how their innovations were not being supported. So I went after the development funders and learned that they were totally ignoring, of course, we already know foreign aid does, but even the development funders with their like 70, 80 billion a year are totally ignoring the opportunities to invest in innovation-based African-led ventures, Black African-led ventures. The white ones were getting all kinds of stuff from South Africa. But I mean, that's what I discovered, that so many innovations came from Africa, but that I used in America, but I didn't know that they came from. Anyway, so I was encouraged and inspired all along the way. But then when I met with Mampela Rampele of South Africa, she challenged me to help attract what she called foreign direct investing. So I launched that effort in 1997 to try to figure out what kind of funding would be appropriate. And I had been doing angel funding as well. And I realized that that the other funders, both on the grant side and the development funding side, were missing the mark, because the opportunities lie in the emerging startups that were innovation-based and tech-driven by diaspora, usually people who'd had global expertise, knew both sides of the equation, and were competent to be able to lead the charge. So once I met my African team in 2009 when they were still finishing their postgraduate degrees and things. And we started working together with a shared vision of how to help African entrepreneurs develop their dreams and solutions. That's probably a good enough start.
Yeah, no, that's super helpful and the background. And I think getting the initiative and understanding the lay of the land is helpful. And so it goes out, like, we get a lot of questions from entrepreneurs at Stradford about deal flow, you know, how to get plugged into deal flow. And then there are also investors that are looking for deals in Africa. How are you finding deals yourself? How are you sourcing them? Where should entrepreneurs be looking to get plugged in? How are you hoping to sort of scour Africans' plane for deals?
Yeah, deal flow is always an interesting one, because a lot of the narrative in VC is that people go out and tout how many deals they see on a weekly basis, on a monthly basis, and then, you know, just to showcase that they're seeing all the deals or nearly all the deals, and then they're you know, they put them through a funnel, and then they only do a few, right? So it works out that they're doing, on average, maybe 1 in every 100 deals they see, or 2, and they tout that, you know. And, you know, venture capital is funny because, you know, I don't actually think it matters how many deals you see. I just think what matters is that you're doing the right ones. So, because at the end of the day, it's a returns business. So I could see 10 deals, you could see 1,000. I pick 2 out of the 10. You pick 2 out of the 1,000, and, you know, and I perform better than you. It'll have had nothing to do with how many deals we see. But what you're also trying to figure out is that you're trying to encourage entrepreneurs to find you, right? And this has also, I think, been a problem, because venture as a whole, and this is probably a US problem, maybe more so, maybe less so, slightly less so in Europe, is that, you know, they talk about, oh, we expect entrepreneurs to be able to find us, to be able to, you know, find us on LinkedIn, then find who knows us, and then come in through what they call warm introductions. So you come in because, someone who they know and they trust, has made the introduction. I've always found that to be nonsensical, because at the end of the day, what you're really doing is you're trying to pair financing with, a really, driven and great entrepreneur. And sometimes, not sometimes, a lot of the time, a lot of entrepreneurs who we found to be incredible don't have the networks, they don't have, they don't have a lot of these things, but, what they're able to do is to build businesses from the ground up. And so for us, what we're trying to do is, we occasionally write there's some social media stuff in there. You write blog posts, you do this, you do that. But the one thing that we've done, I think, a really good job of is that we don't believe in just warm introductions as a source. So people go on the website, and they we have a form, and what that is actually designed to do is to ensure that the entrepreneur can put his or her best foot forward in articulating what they're doing. And we have that set up such that once you fill the form, everybody in the firm sees it once it's submitted, right? So, and that's usually sort of the way, because each person in the firm is going to have slightly different interests, right? But that's usually the way to, for at least one person in the firm to go, oh, that's interesting, I should reach out to that founder, right? We also get deal flow from existing founders that we've invested in, founders that we haven't invested in, even those that we've passed on, strategic partners, other investors. So it's a variety of things, right? But what is super important to me, I think, is that entrepreneurs have access, right? And that whole traditional, you have to have networks, which I think is actually, it kind of screws up with, either minoritized founders, women founders. It just sets the game, I think, against them in a way I don't care for. So we try to be as accessible as possible. I mean, we probably see on average coming in through our website, anywhere between 4 and 10 pitches a day, just through the website, right? Now, there's all stuff, the stuff that's coming in. It's coming in on WhatsApp, it's coming in on Twitter DMs, it's coming in on LinkedIn. But the key thing is just accessibility, right? And I will just add one more thing, because, this is also an important message I like to send to VCs who sort of still run around thinking, well, if you don't know anyone who doesn't know me, then, shame on you. We have 2 deals that came in through the website, us, and they're each fund returners, right? In other words, when we invested versus what they're worth today, our holding in each company is worth the same as the fund we raised and from which we invested, right? So, I mean, if someone had been trying to figure out how to get to me, would have missed it, right? So that's the key thing. But, one of the things that we try to do even in the form, and this is sort of a dry run, I'm sure we'll talk about it, is we try to organize the structure of the submission. Again, like I said, to put your best foot forward, right? So we see some rawness when it comes in, that's all I can call it. But it is really about being able to organize your thoughts in a way where a venture capital investor can process what you've submitted and then decide whether or not it's interesting. Because, a lot of founders are so dialed into, oh my goodness, this is going to be a big company, that they forget that the first thing they have to do is to be interesting, right? And so that's one thing we've tried to do. It's there's stuff we'll talk about, like what you put in the pitch deck and a bunch of things, but that's something I'll point out.
A quick follow-up on that. You mentioned like interesting. So I guess for the audience, what you're talking about is on your website for Echo VC, there's a form for an entrepreneur to submit information about their business to reach out to you. How how have you found entrepreneurs to stand out to be interesting?
Well, it's a pretty wide range, right? So one of the things I think, and maybe it's just a thing we have for underdogs, is that we've found some really good founders who are poor storytellers. Just poor, right? And at the same time, we found some founders who are fantastic storytellers and poor business and fantastic storytellers, not so great founders.
Yeah, exactly.
So that disconnect happens a lot, right?
Yeah.
And so you've got to be able to pass through a submission. Like one of these fund returners, we still have the submission. He submitted twice. The first time was so bad that I don't think anyone actually paid attention. And then 6 months later, he submitted again, but it was, when he submitted, sometimes I tell you how luck works out, right? I'm on my email when the thing comes through, right? And I actually had some time. So I just sat down, I read through it, and I was like, okay, it's not the most well packaged, but there's something here, right? And you start to dig in, right? So when we talk about being interesting, Songa, it is about what is that best foot, right? For a lot of people, they're like, look, I don't have time to process this. So, if it's someone I trust who thinks you're worth introducing to me, then that's sort of my filter. Yeah, but it really comes back to the founder to sit down and say, when you're writing these things, okay, am I being interesting? Right? Is someone going to read this thing and go, I want to have a meeting with you? Because that's how it works, right? You're not going to get money because you sent in some stuff, but it's going to be like, am I going to be interesting? And that's the reason why we send these things to everybody in the firm, because what is not so interesting to me might be really interesting to Taiwo, right? What is interesting to Taiwo might not be interesting to Senda, right? So there are all of these things that sort of play about. So we like everybody to sort of come in on a level playing field. But that storytelling thing is such an important thing, especially in Africa, because a lot of founders that we've seen, they get some coaching and a bunch of things and whatever it is. And, many times they don't really listen. You're telling them, look, you're going to go talk to these people. This is what they're looking for. And sometimes you miss out. There's a story, and I'll hand this off to Marsha, because I know Marsha's probably going to have a whole bunch of stories about this as well. There is a story when I tell founders that these VCs can be ruthless. His meeting was scheduled for an hour. I think it lasted 7 minutes. The VC took umbrage at the first slide. They didn't get past the first slide. He disagreed completely with everything on the first slide. The meeting was all done. 7 minutes. Done. So when I tell you, you need to be interesting, and you need to be interesting immediately, it's critical. It's absolutely critical. And interesting could be, I have a real business, right? I put in, we have a bunch of these companies in the portfolio. They raised $100,000, $200,000. They're doing 3 million in revs, going up to 9, 12. You stop, if your opening slide is that's interesting. Because people are like, what? You leverage that little money to create this kind of business? So that's an example of being interesting. But, you're begging these entrepreneurs, put your best foot forward, put your best foot forward. Yeah. I mean, Marsha is laughing. I know she's seen stuff.
I love stories. I totally agree with him. Do you want me to cover this question or another one?
Yeah, no, I think
the one about deal flow.
No, deal flow is certainly important for the audience, and I think Kuza mentions an important topic on having a prepared pitch deck. So we've introduced office hours at Stradford Venture Partners, where we have entrepreneurs come in and get an opportunity to get coaching from us. And I think most of the time, a lot of them don't come with like a pitch deck, right? So we coach them through that. And Marsha, in speaking about deal flow, you sort of broke down when we started preparing for this meeting, talking about like what you have on your website and intake. So I'm curious sort of like how you find deals, and then also, feel free to shadow comments from Igosa on stories.
In 2007, a Kenyan entrepreneur brought me with her to a United Nations session where they had me speak about how I could see diaspora plugging into the whole ecosystem of African development. And I was just shocked that during the break, the United Nations officials themselves were overwhelmed with the fact that they actually had a real live African entrepreneur in their midst. This tea producer from Kenya, and I just thought these people have like never seen a real African entrepreneur, and they're at the United Nations hosting this, global conference on African entrepreneurship. So I realized there's a big problem here. Then I go to IFC and they say, well, we've got this huge budget for African investing, but we can't ever deploy it every year because none of these, we can't find a single entrepreneur hardly that can take our minimum $20 million checks. Can you believe it? It's like, it's all the African entrepreneurs' fault, right? I'm looking at them thinking, are you kidding me? The average entrepreneur I've met is ready for $100,000, maybe $200,000. You give them 20 million, you're going to waste it. And that's exactly what they did. They wasted all their money, every single one they set up. So, how do you get the right deal flow going? Well, I mean, entrepreneurs know and appreciate each other. They don't so much appreciate government bureaucrats. So there's a big disconnect there in deal flow, right? So what we did as entrepreneurs ourselves was we started by helping entrepreneurs themselves. So we first set up a Lagos Tech Hub in we decided to do this we met in 2009. In 2010, Lofty Inc. was set up as a business consultancy to support the partners as they were transitioning from wherever back home to Nigeria. Then 2011, I think, was when they started actually conducting incubator programs at the Winnovation Hub that we set up as a nonprofit. And then the next year, they started a African investment group, the Afripreneur Angel Group, AAG now. And that was to help support the early stages of these, as well as get more deal flow in. And so you would think that the Tech Hub and the would be the main source of deal flow, but it has not been. That's been more our contribution to the local economy of grassroots. This is what an entrepreneur does, not something that's a globally viable venture that can return the fund, as Igosa was saying. So we didn't start the venture fund until like 2016, but that's another story, because we had a diaspora who, made good. Okay, so help me get back to where I was. So for me, the main deal flow source has always been me going to diaspora things, or them, having me come and speak at theirs. I first went to Wharton's in, 2005-ish. Harvard had a wonderful one led by, I can never say his name right, Julius Salesius. He's passed now, but he was a wonderful advocate for entrepreneurs at Harvard. And then Stanford, I spoke at the first event in 2007, which was launched by Irungu. Irungu, are you on this call? He's a Kenyan he was running an investment banking firm, the top one in the country, and now his interests are more political and policy oriented. So so it was these diaspora networks that I really could sink my teeth into. So you'd have the little pitch sessions and whatever to show things. And then the diaspora of Silicon Valley once I realized that they were forming just the way that the Indians had formed their group, the Chinese had formed their group, now the Africans were forming their diaspora networking groups, I was asked to help with that organization. And I told the organizer, Almaz Nagas, that I wouldn't help her until she had a focus on some event that would focus on investing. And so that's kind of been my trajectory. And as Igosa said, you know, right on a link on the website where you can actually fill out a form and have access and get eyeballs on it. And for us, that first cut separates them between, sorry, you're not ready, and the angel network that invests in pre-revenue ventures. And then our seed stage venture funds that will consider investing as long as you do have revenues on a viable product.
No, that's super helpful. And I think I think that that's the angel network was really fascinating. So, you know, for the entrepreneurs who apply through the forums, like on your website, Agosa's website, or at Stradford Venture Partners websites, there's a coaching mechanism for those who are not ready to get coached. And then once those businesses are able to mature or those leaders grow, then they're funneled out. And I think that that's great for the entrepreneurs in the audience who are interested in, may not be ready, but they would like to test the water. So it's sort of shooting your shot doesn't kill you.
Thank you very much. That reminds me, it's a critical benefit that we have on venture capital side, that our angel network, usually it's partners also who have invested alongside the angels that have specialties in the area of venture. But they already have years of experience with mentoring that team in that market before it's introduced to the venture fund. So we've got, as a venture fund team, we've got this incredible depth of expertise of professionals who are now investing, and of entrepreneurs that were successful in investing. And so they know the markets, and you know, these are all African investors. So you don't have the problems of an outsider coming in and trying to bully the entrepreneurs into changing their strategy and then failing, and then, you know, fingers pointing, and oh, it's terrible. Anyway, yeah. So our best deal flow, our most assured, lowest risk deal flow often comes because our angels have already invested those early $5,000 checks.
And it goes just real quick before it turned to you. I know you had a comment. So just my understanding, the angel network, those are like from a US perspective, an angel investor is generally like someone who has a certain amount of like assets at a threshold, maybe like $1 million, $2 million, or brings in a certain amount of income. And these are seasoned professionals who will coach the businesses before they get ready for an institution like a venture capital firm to invest. So it looks like you've developed a network of professional angel investors who are professionals who have high net worths, or, you know, have extensive experience in finance, who can coach entrepreneurs.
Actually, several, right? The first we helped with developing the Lagos Angel Network. The L in Lagos was supposed to be Lofty Inc. Angel Network, but then municipal funding came in to help support that effort, and so we, you know, generalized it. And then Idris led, I think he led the development of the Afripreneur Angel Group. In the US, I had been doing the same thing with impact investors. So I knew how they operated and what the processes were. Thank you.
Yeah, no problem. Igosa.
Yeah, no, so I think the networks, I was just going to point out sort of two things. One was these angel networks are usually very helpful as well in terms of sort of sourcing deals. I always sort of caution entrepreneurs that they should also sort of be careful about the expectations for where they're going to get coached and how they're going to get coached and who they're going to get coached by. Because you can get into an angel network, or you can get some money from some angels, and, you know, and it's kind of tough to to accept this, but some people are good for money. Some people are good for advice. And quite often they're not the same, they're not the same person, right? And so you've got to be able to sort of make your judgments sort of around that. But the other point I was going to make, I think Marsha had mentioned this, was that, as entrepreneurs are sort of trying to figure out how to get funded, right? There is some homework that needs to get done, right? And and I can't stress this enough. When you go reach an investor, Google is your friend, right? You should be able to have a very high level understanding about what types of investment that investor has made before and what types of things that investor is interested in. Now, investors don't necessarily make it very easy for you to sort of parse that, but you can have some directional orientation around what's interesting. And I say this because, our website, I think, is pretty clear that we like technology and we like technology-enabled businesses. But I cannot tell you how often a week we get pitches for farmland, for fisheries, for everything that's not tech, right? And you're sitting there going, do I need to sort of change my homepage and say, please, do not come in here unless you're tech? No, but it is a sort of a.
They need to do their homework, right, Igosa?
Yes, it's just it's simple. Google's your friend. I
want African founders, and I keep getting American, European. I mean, they're not African. So I always say, if you're an African founder, you can use our link.
Yeah, no. So we are. I think. No, I mean it's actually interesting because, one of the things that and we're going to get profiled soon. One of the things that I think, I don't know if we've done a very good job of communicating, is that we invest in underrepresented founders, so women, Black, brown founders, and we invest in underserved markets. And what people, I think, assume is that, well, okay, they invest in Africa, so that's the underserved market. But that's not technically true, right? So we had to pull together some of the investments we've made. Some of them we've not disclosed. So I was explaining to someone that we'll invest in like white founders, but they're doing things that are addressing markets we're very interested in, right? So for instance, we have a stealth deal, where the founder is, they're doing some very interesting work in protein folding to address sickle cell anemia.
Yeah.
Right.
Yeah. We do that as partners. We do that as partners instead of in the fund.
That's a black disease.
Yeah, right. I agree.
So we invested in that. We invested in another one that is doing essentially telehealth for dermatology, right? And and doing stuff for skin diseases and skin afflictions, and it's AI powered. But why we invested in them is because the founder is committed to doing a bunch of work around, AI analysis for Fitzpatrick skin types 4 through 6. So if you know anything about sort of skin types, right, 1, 2, 3 are essentially whites and some shades of it. 4 through 6 are brown through black. And if you know sort of what you're seeing with edge detection and photographs and a bunch of things, right, that stuff is just being left behind. And that's not to say that people who have, black or brown skin don't get skin cancer. They do, right? But there's almost no body of knowledge around that, right? And so we did that. And so you're like, oh, those are white founders. I was like, yes, but they're doing very specific things that are interesting to us, that serve a market that there's almost little to no activity. Right. And so that's why it's kind of, I know it's kind of important. I don't think, being self-aware, I don't think we've done a really good job in communicating that when we talk about underserved markets as part of our thesis, it's stuff like that. Right. So you could sit down in Europe, you could be sitting down in America, you could be sitting down in Latin America. And but you're interesting to me because of what you're doing and the market you're serving. Right. And some of these examples, these founders were not thinking of these markets. We brought the markets to them and said, have you thought about this? Have you thought about that? And they go, oh my goodness, I did not know about this. And then the product now starts getting tuned to serve these markets. And that makes us, that's certainly very satisfactory to us.
No, that's a helpful breakdown and, sort of instruction to the audience that each investor has their own thesis that they've crafted. And that's usually should be available, as you noted, by a simple Google search or landing on a website. So before preparing to pitch your business to an investor, it's great to understand that whether your product fits in the thesis or their focus. And having a thesis, even though it may be Africa focused, doesn't mean you're shutting out all potential entrepreneurs, because it could be someone who's based in China or Australia who's focused on, your emerging market or underserved markets. So I think that that's super helpful. So now talking about, we've talked about how to get in the deal flow, how investors can find deals, how entrepreneurs can get into deals. We've talked about why Africa, but I think one of the curiosity for a lot of folks is the due diligence process, right? For me, I'm based in the US. I think Marsha, lastly we spoke, you were in the US, Ghost is in London. So we're talking about finding out whether we want to do a deal in a separate continent, right? In another continent. Marsha, I guess sort of just like breaking down what is important for you when you're diligencing deals in Africa. So just for the audience, when we're talking about due diligence, for the entrepreneur who's prepared their pitch deck, who says, this is the product we have, this is the market we want to serve, here are our projections, we think we can do X amount of money this year and next year, will you invest in me? And now after Marsha says, yes, I like you, you have it goes and says, I like your story, they have to now investigate, right? So but what's important, because we have an Africa audience, what's important for you in the due diligence process?
Passion. There's not enough data to fill a spreadsheet for seed stage ventures that we focus on. So the most important thing is the entrepreneur's passion, which usually and most profoundly effective is if they are, did I lose you?
No, I'm here.
Oh, we can hear you.
Okay. If they are passionate enough to be doing this because of loved ones that they really truly care about, because they're going to be facing a whole lot of discouragement and challenges and cliff edge scary moments before they succeed. But if they are doing it because they really care about a loved one that has this problem daily, and they know a solution and they know they can solve it, that's number one. But of course, if they truly are like that, then and they don't have big fatal personality flaws, they will have been able to also convert their colleagues into teammates, co-founders. And if they don't have co-founders, that's a huge red flag, right? And then if they can't articulate their solution, that's a real problem. It's not a matter of the deck, and I'm terrible about being able to communicate by decks as well. So I so understand that. But if they truly thought about the problem long and hard enough, that their solution is going to be innovative, unique, and truly scalable, impactful. Even though as I come in as an investor, at that point, I still expect the business to twist about 3 times before we get to an institutional level. They're going to pivot away from some things that aren't working so well toward other things that are. That's sort of in the nutshell. My team does a far better job of the next stage of screening. Kevin Simons, Idris Bello, Michael Olawaguni, and the big part of that is their networks. They have vast, deep networks of sector specialists that work together with them on evaluating each deal, so it gets a fair evaluation.
No, that's super helpful, and I think you talked about networks last time and developing networks, and Igosa, you mentioned that as well, and that's super helpful. I come from a region where whoever is in political power has huge control over the business, right? So for outside investors, it's hard to create or sort of like advise on this risk. So Igosa, in your experience, like what are you rating for African founders? Like beyond the typical metrics, like you're in Africa, what is important for, because we've got folks from New York, Chicago who may not have visited the continent or have some familiarity. What are some like unique aspects of your due diligence process that are specific for African deals?
It's a good question, in part because of the timing of this conversation. So some of you are probably aware of what's been going on there was a TechCrunch article about a company in Ghana called Dash that raised I don't know, 32 million or something, and the CEO has been put on indefinite leave, and the whole chatter is that a lot of the numbers were probably made up and all that good stuff. That's still, I guess, being probed. But it was always interesting because there was a lot of chatter about it on Twitter a few days ago. And, and people were like, well, when the deal was announced, everybody was like, oh yeah, these guys have done $1 billion in volumes. And people were like, we've never heard of this app. We don't know anybody that uses this app. It's like, where are these volumes coming from? Right. And so what you see a lot in diligence on the ground, and again, remember, because I talked about the life cycle stage, diligence at the end of the day just comes down to, people, the technology, and the market opportunity, right? At the very early stages, the very, very early stages. As, that is if they don't have a product. If there's a product, then you add product diligence. And later on, as the company has sort of evolved, depending on where you're coming in as an investor, you're also trying to figure out whether or not they have product market fit and what the go-to-market motions look like. But the reason why this conversation is funny is that an old friend of mine was the one, he tweeted out this article about this Ghanaian company, and he goes, "Oh, I forgot to tag Egosa," because he collects stories like this to make sure he's not a victim.
Yeah.
And so we were like, "Oh, really?" And he now goes, "Oh, that's how he would show up at the founder's office in jeans and a t-shirt, real casual, and says, 'Oh, let's go to the market together.' And then when he gets to the market, he'll be counting your customers and your users, right? Like himself, not like you're telling him how to count them. He will count them himself." And it's kind of a joke. But I think a lot of it, and I had to explain to people that a lot of what drives my diligence processes now, I think, really was, it comes up from an investment I made 15, 16 years ago in Japan. And I'd done all the diligence, put 2 million, let's put in 2 million in, done all the diligence, all the paperwork, everything, right? Called this, called that, verified all of this stuff. And I was like, great, So I was in Tokyo, and we had this whole thing where there was going to be some ceremony to sign and a bunch of things. So it was a $5 million round. We were putting in 2 million. And I remember distinctly when I was in another conference room and I was waiting for everybody to join me, and I was looking out the window, and I just felt odd, right? So there's this phrase called Nigerians say, your stomach was doing you one kind, right? Which is, it's just, that's how this phrase is delivered. Your stomach was doing you one kind. It is sort of like, you know, your belly's kind of a little off. And I felt a little off. And I did not know what it was, but I just felt off. Right. But you know what? I was like, you know what? Let's move. Let's go. Did the deal that in any event, the entrepreneur defrauded all of us. I lost my 2 million. And you know, and I did several postmortems about, you know, on that deal. And I realized that, you know, there were things that, you know, you could have done better and whatever it is. But at the end of the day, the diligence was actually really good. Right. But what we missed was that the founder would become somebody else with $5 million in the bank.
Mhm.
Right. And, you know, and what I beat myself up about for a while was that I didn't pay attention to my instincts, because that's what my belly was doing. My instincts were saying, hey, there's a red flag here. And so for us, you know, when we do this diligence in Africa, particularly what Marshall said, where there's a paucity of actual data, especially if you're doing it sort of really, really early, you're going to be sort of doing diligence in both a sort of linear way and an orthogonal way. So linear is a very straight line, you know, who is this founder? You know, what are the founder references? Founder references are always interesting because in Africa, for instance, I learned doing this when I was investing in India. You give me a list of founder references, those calls are 5 minutes long. Because, you know, all I'm looking for is who those references think know this founder. Then I will have to create my own set of references that were never given to me by the founder. And then I can then triangulate a view about who this founder is. The same thing with these markets, right? And in Africa, what's also interesting is that, especially if you're investing in businesses that are in regulated industries, so for instance, financial services, right? We saw a lot of stuff happening in financial services. Just, you know, the dollars were plenty, the deals were fast. And, you know, we didn't do very many of these deals. And I think partially because we questioned like where these markets were. We questioned why these founders were choosing markets versus other markets that we thought were being left behind. And then we also questioned just sort of money flows. So like, you know, these revenues you're recognizing, are they all yours? Because we kind of know who's participating in the revenue flow. So you're declaring revenues, and I'm like, but those are not your revenues, right? And so diligence in these markets can sort of require a third eye, right? And that's not to say that you're necessarily dealing with founders of low integrity. It is just that you get, you know, as my buddy says, I will go to the market in jeans and t-shirts. You know, we're not trying to make these things some sort of formal 3-piece suit investigation, right? It's not an interrogatory. But I want to learn this market just as well as you, right? And I want to sort of understand the hidden dynamics of this market. And then I think the final thing for us when it comes to diligence, and I think, again, that's probably me fitting into the culture of my firm, is that there's a question I like us to be able to answer before we fund a deal. And that is, who is this founder when no one is looking? Because, like I said earlier on, there's some very, very good storytellers. We've seen them in Africa, right? Some people will ask me things like, why did you do a deal? And I'll be like, oh, I wasn't interested. No, it wasn't that I wasn't interested in the deal. I wasn't interested in the founder, because I know that founder is going to be problematic. And I have not missed on that, to be honest. In the 8 or 9 years of been doing this thing, I have not missed. When I tell you that there's a founder, you know, who, as my buddy would say, his mom will say, it's not very straightforward. You know, I have not missed. And some of them have gone on and sort of raised money and so on and so forth, but you kind of know that at some point in time it's going to implode, right? So, you know, bringing all loop, you know, back to the question, how do you do diligence? You do it with a third eye, right? When you're doing it in Africa, you make sure that you validate the people. You make sure that there's actually a product. I mean, Africa is a very interesting place. Like, people would make a declaration about the existence of something and say it so confidently that you would take their word for it. Meanwhile, the thing doesn't exist. Like, doesn't exist, has never existed, right? And the good thing is, because I've also seen that behavior elsewhere, not just Africa, I don't sit down and go, I'm going to write of Africa because someone lied or someone made up stuff. No, right? You just get more careful about that. And, and the other, and I think the final sort of, message is that even the institution that you think, right, should work right, should not cut corners, that's not true at all. So again, who are these people? Whether they're the founders, they're the strategic partners, and all that good stuff. Who are they when no one's looking? Right. And for us, that's the key thing, because integrity is a very important thing for us. We don't care. Yeah, you lose money, it's fine. This happens in venture. But, we take the money we've been giving to invest very, very, very seriously. Right. And we expect that the founders also respect that. And so our process will give you a good insight into the value that we've attached to the dollars we're deploying, and the respect that we've attached to the dollars and we're expecting that that's going to be a two-way street. For some founders, they think, oh, it's a little bit burdensome and the like. But, for others, it is what it is. And, I've been trained in a very interesting way. My old boss, when I was at Intel Capital, he told me something very hilarious that I never forgot. He was in some meeting with the Enron boys, and this is many, many years ago, right? And I think they were trying to raise money for some, I don't know, one of their hedges or something. And he's telling me the story. It's a very funny story, right? About how, and all the people in this room are all the names that you've seen in the stories. And he was just talking how fast this guy was talking, and he just had a very simple approach to fast talkers. He says he'll just ask you the same question 5 times. And if the answer changes once, he's out of there. He is out of there. Right. And apparently that's, and I've never forgotten that lesson, right? Because people who sort of, and you can adjust if people are nervous and but when it comes down to the business, it's going to be very, very, very important, right? And one of the things we love about women founders, particularly in Africa, is that, we've also sort of made this thing where we try not to have these pitch meetings with decks, where they're walking through decks. We instituted that as an early process. And we just want to get into the business. And when you see the way they light up about the business and the details and the mastery they show, that's what you're looking for. Right? The diligence can do whatever it is, but I can sit down with you for 2 hours and you would get into the details of this business and the insights and the behaviors of the people in the industry and what works and what doesn't work. And you're like, that's what I needed. So diligence is like an elephant. Wherever it is that you're touching, could be different parts. You never know what it is, but at the end of the day, it ends up being the same elephant.
No, that's super important, and I appreciate you giving like a lot of good nuggets that obviously the audiences appreciate, and things that I want to I'll take. I don't think I'll go to the market and start counting, but that was super. And I think also another thing that you mentioned and Marsha also mentioned was like networks, and when the investors are diligencing, it's important, or most investors are going to double check the networks to check your integrity. How do people view you when no one's looking? And then I think you also pointed on who's also investing alongside the founder locally, right? And that's super helpful. Like, have you been able to get a local venture capital firm or local angel investors who are the professionals who meet a certain criteria to invest with you prior to reaching out to getting more money? I know.
And the team. What kind of people are willing to give up their lives to work with this guy or woman?
Yeah, and you mentioned that, Marcia, in a great way, the conviction, right? I had recently met with a founder who had a great idea, and then it got done, and I was wondering, like, why is this a solo founder? Why, and it just raises a lot of questions, right? So I think that's important, bring a team. I sort of want to close the
So
loop.
Sunga, I would tell you that our best returning portfolio companies, like undoubtedly, like the best returning portfolio companies, have solo founders.
Oh, really? Well, why do you think that is?
None of ours do.
I don't know. This is the
None
thing
of
with
ours
venture,
do.
right? Yeah, this is the thing with venture, right? This is the
Yeah.
thing with venture, right? Like I said, a blind person handling an elephant, as you move around, you don't know what it is. You hold the tail, you think it's a snake, right? You hold the leg, you think it's a tree trunk. You don't know. We don't know, right? If there's a narrative, there's a counter narrative, right? But I'm just saying though that every time I hear, because we see this a lot, we see it a lot in two ways. Everybody sort of gets into this, they fall into this thing, right? One of them is they don't invest in married founders. Well, I know many venture capitalists that will not touch married founders, will not touch. And I understand the risk, right? I get that. But
Oh, you mean if both people in the couple are co-founders? That's
yes.
what you mean. It's not that you won't invest in a founder if they're married.
Who's married? No, yeah.
No, it's the couple.
Right.
Yeah, because
Yeah,
the
no,
couple
if you're married,
is
it's
split
good.
up.
Yeah, that's great for you.
Yeah, no,
right.
the founder
But
needs to be bigger. The team needs to be bigger than those two people too.
They won't do that. And then the other thing, the other narrative is the sole founder narrative, which is, oh, I'll never do that. And meanwhile, what you really should be looking for is not, is this person a sole founder, but what sort of attractant does this person carry that brings other people around, right? And I get it, right? I'm a sole founder of my firm, and having another founder to be able to hand off stuff and whatever it is, absolutely, I can be here all night telling you sort of the qualities and the advantages to it. But I'm also saying that if you have people out there saying, oh, if you're a sole founder, you're not going to get funded, it's not true. People saying, oh, if you're a sole founder, you can't succeed, not true. If people saying that you have married co-founders, you can't succeed, not true. There's some gigantic wins in all of those categories. So just pointing that out there.
Yeah, I agree. It tends to be subjective on what the investor's preference is, and those are certainly good nuggets. So we've gone through the journey of identifying African markets, getting into the deal flow, talked about due diligence, and then I think just sort of real quick, before we get to questions from the audience and close, I want to sort of talk about exits and Marcia, we sort of previewed like check size and everything, and Marcia's firm, I saw a report recently that you're one of the top firms who've done deals in Africa recently, so you've done an amazing job. Sort of just for the audience, like the importance of like having an exit to make a successful exit. So when I say exit, for some of the audience members who may not know, so the venture capitalists are investing in the business to get equity, an ownership stake in the business. And the hope isn't that the business survives forever. I mean, the investors want to make their return, right? And that's what is called like an exit opportunity. Someone buys the business and buys you out, et cetera. What is your, like, maybe give us a story of your most memorable exit or your favorite investment that's done and maybe talk about a multiple in Africa, or to give a picture of the opportunity for the audience.
Yeah, if I may, I'd like to preface that by saying that when we exit, it's not because we have any disregard for the business, but rather we recognize that other investors are better at later stage, or more focused on later stage, less able to come in early. So we turn around and put the money back in early. Now, I lost my train of thought there. Help me.
No worries. We're just sort of like
exit. We're talking about exit.
Exit story.
So,
just
well,
to give
okay.
A picture
So,
of the potential.
Yeah, the reason why I helped I joined the team to found our venture fund was because when I was helping to set up this diaspora network in Silicon Valley, I was looking for speakers, and front page news was in June 2016 that Mark Zuckerberg of Silicon Valley was on the streets of Lagos. And so I pinged my team and asked questions, and they said, well, yeah, he invested in one of our ventures that our angel network invested in. I said, what? Tell me more. So, it was really exciting to learn that they had invested in E when he was 19, probably a single founder back then. That failed. But we said, don't worry, it's equity money. You don't owe us debt. Come back to us with your next venture. We still believe in you. I'm saying we, but I didn't know what was going on with my team at the time, but my Lofty Inc. colleagues. And so he came back later with Andela. And so Andela was what Mark Zuckerberg led the $20.4 million, I don't know, what was it, A round it goes to, but then he, of course, he left within a couple of months of that fundraising and started Flutterwave. And I knew I wanted to get into Flutterwave, and so I joined the team. I had previously been spending over a decade as a single founder of my investing, and I was terrible at it. But I'd learned a lot and learned what not to do, and knew that I wanted a team. And so my team joined me in founding the first venture fund. So, but we spent over 4 years trying to raise our $25 million fund. And you look back, and it's laughable now because we only raised like 1.2 million. Well, why? Because nobody had a reason to believe in our strategy unless we exited and had proven that our strategy worked, right? So we in that case, we chose to exit Flutterwave with I guess it was an 8x, something like that. We knew we could have held on and gotten 20x in a couple more years or something, but we needed to put a stake in the ground and say, this is what we have done. We nurtured this entrepreneur from the time he was 19. We have exited his venture, and our investors have all, to a man and woman, reinvested that money with us in the following fund. By the way, the entrepreneur also has reinvested in other African entrepreneurs. So it's a great story. It's a virtuous cycle that is perpetuating, is sustainable, is profitable for everyone. And it's my favorite story.
Flutterwave is certainly, I think the folks in Africa may be familiar with Flutterwave, but that's certainly a great success story. And, getting 8 times the money that you put in as an investor is always an exciting opportunity. I do want to, as we sort of close out in the final minutes, I want to just get to some audience questions just to get some level of engagement. Let's see. So he goes, so I've heard you speak before, you're a straight shooter, and maybe let's see your thoughts on this question. And Marsha, feel free to chime in on this one. We got this one by email, and when I first saw it at first glance, I thought it was a little bit more simple, but then for some reason I continued to ponder on this question. And the question is there discrimination in venture capital, or is it more the African founders? They're wondering why the white counterparts tend to invest more in white-led startups and why African venture capitalists and venture capital opportunities seem not to compare. So just
It's a tough question. I think I still remember some of the chatter around the Kenyan ecosystem. I think that's changed. It's changing fast, right? So I think you've seen certainly last sort of 5-10 years, of course, right? And that was also attributable to non-African founders who just had better networks, different access. But I'm so confident that it's changing. We're seeing a lot of the deals getting done that mostly sort of African founders. I mean, there's certainly non-African founders still coming in. But make no mistake, the African founders are doing quite well. So I wouldn't call it racism. I think, I lived in America for a long time, so I know exactly what racism looks like, and it's a real thing. But I also think that as the big dollars are not local, right? So that's another problem, right? You can't get the big pension funds to come into venture, right? Because on a risk-adjusted basis, but just fixed income is so much more interesting, right? So again, back to Marsha's point, the big dollars locally are looking for exits to validate that these VC strategies work. And so a lot of what you see when people invest in the people that look like them is pattern recognition, which is because the people that look like them have done exits before, right? So until you start to change the narrative by showcasing other things, other possibilities, right? Then, people now have to pause and go, whoa, okay, right? Like I keep saying this thing, until an African-led, the sub-Saharan African-led tech company goes public, not just in London, but maybe NYSE or NASDAQ, right? And it goes public at a gigantic valuation where people are like, holy smoke, that is a gigantic business, right? You're just going to have people who are like, this sounds like hand waving so far, right? So part of what the work that we are doing as a collective, as a community, founders and investors and strategic partners and everybody in between and customers, is to build on those narratives. And those narratives take time. And when I tell people, everybody's like, we came out of a zero interest rate era, so everybody was just excited and, unicorn, you got to $1 billion valuation. But when you look at some of these companies, right, that have become material outcomes, right, they are not spring chickens, right? A lot of the stuff in the last week has been about Stripe, right? Stripe is technically a 2009, 2010 company, right? It's 13 years old, right? They don't just show up and whatever it is. So, and by the way, that's a company that's in the US, which is an economy and infrastructure that doesn't have as much friction. There's a whole bunch of things, and it's still taking them, maybe 14 years before they go public, right? Then you now come to Africa where you don't have a lot of that. You don't have the infrastructure. So that stuff is gonna take time, but we will change the narrative. We are changing the narrative. There are big African-led companies coming. There's no question about it. And so we just have to just keep plugging away. But we have to be patient, right? But make no mistake, I think more and more African-led businesses are getting funded. Absolutely. Super confident of that.
Well, the details are out there pretty well covered by Big Deal. I mean, they don't catch everything because we don't bother disclosing everything in
That's
time
true.
for their things. But look up Big Deal Africa number of deals. You'll find some good stuff.
Yeah, Marsha, I don't know if you want to answer the question. Do you see there being discrimination in venture capital, particularly as it relates to Africa? Is there some sort of, I know we talked about.
Well, yeah, that's why I invested in Africans, Black Africans especially, because I started working in South Africa in 1997 through a corporate joint venture, and I found myself just sort of funneled in automatically to white African innovators through the private or intellectual property attorneys and the tech hubs and all that stuff. But I backed away from it, went back to my American diaspora networks and re-entered a different way. because no, that's not going to work. But to me, there's so much more opportunity. You know, the whole concept that a diverse team and diverse founders innovate more sustainable solutions is so true, because and there was research done on this. I was on a panel and learned about the research that it showed that one of the main reasons is if everybody, all the decision makers are too much the same, too much alike, they're going to totally miss opportunities and risks. And so the diversity, you know, when you come into a board meeting knowing that you're going to have a diverse opinion, then you can't just say something and expect it to be accepted. You've got to come in and expect it to be challenged, and to keep your mind open to what that person's going to say, or you're going to have a terrible board meeting and a terrible outcome.
Yeah, I'll add one more thing, which is the gender thing. That is so annoying and so frustrating, because female founders, right, also struggle, right? So we've talked about race.
Really? Tell me
right?
about it.
That's, you know, that's getting better, but female founders struggle, right? It's unbelievable, right? Because you see. No, I'm just saying that we're seeing that as well, and that's something that needs to change, right?
Okay, so what's the solution? What's the solution? I saw data on this in 2007, so I know the solution.
Yeah.
The solution is to have more female decision makers on the investors panel, right?
Yes.
Okay, and that's happening. When we started, you know, people kind of were looking at me saying, well, why aren't you favoring female founders? And I thought, well, I don't want to, it's my money being invested. I don't want to lower my standards just because they're female. But on the other hand, I also knew there's more opportunity because there'd be less competition for the deal, right? Generally speaking, used to be. Now there's maybe too much competition for good deals. But anyway, the point is that that now our numbers have gotten up to where about a third of our ventures have at least one founder, and usually it's the main founder. So it does change, and that's the solution. Just get more women on your team as equals.
No, I agree with that. I just feel, I look at the US and I pointed something out, which, you know, maybe a little bit more nuanced, but people don't see this. It comes down to this pattern recognition problem. And that is, people all assumed, you know, after the George Floyd thing, oh, we're just going to do diversity. We're going to throw money into DEI. We're going to give a bunch of money to women-led funds. And the numbers didn't change. In fact, the numbers got worse.
That's right, because you don't,
like, well,
all women-led funds are all women again. You don't have the diversity. You have to have the diversity. If you don't have males, if you don't have males in leadership, and if you don't encourage the males in management, you're going to have the same problem. I invested in 2002. I invested in the Texas Women Venture Capital Fund, women managed fund, women venture. What do you call it? Business founders, and it did terrible.
Yeah. So the other point, I think, you know, when this came up about, you know, do you get women-led funds and so on and so forth, I just pointed out, I said, look, because they're women-led funds, right, they're still funds. And one of the biggest challenges is that as a VC fund manager, very similar to an entrepreneur, right? What's the entrepreneur's role when you interact with a VC? You get a second meeting, right? What's the VC first fund manager's objective? To get a second fund, right? And so, you know, usually in the US, you're sort of out fundraising within 2 or 3 years of your first fund, right? And so what you then find is you're going out talking to these limited partners who are going to be giving you investors, who are going to be giving investor dollars, and they're asking you, what did you invest in and who did you invest with, right? And so what you then find, you know, and I pointed out, like these managers it's tough for them because they now invest in the same things, right? Which would generally be, by definition, white male-led companies, because you need to be able to show traction, right? Because what we have found is that underrepresented founders or women founders tend to have companies that ignite a little bit slower, right? Because they tend to manage capital in a different way. They're not going to sit down there and burn capital, high growth, let's push, let's burn everything. And we're running out of money in 3 months, let's go and fundraise, because they've never been able to fundraise in 3 months, right? So they don't take a lot of those things for granted, right? It's a very complex thing. Certainly worse in the US than elsewhere. But one of the things that's sort of important is that, I think as Marsha says, first of all, recognizing there's a problem, pointing that out to investors so that they can actually become more self-aware, right? And then now saying, okay, look, report these numbers so we can actually see that you're not sort of doing pattern recognition and only funding guys who went to Stanford, right? You're looking at a variety of very interesting founders. If we look at our portfolio, right, we have our best returns are going to come from women founders. We know that already. We know it, right? And so it's one of those things where you're sitting there and going, okay, let's do better, right? So hopefully that addresses the question, but it is.
No, that's super helpful.
It'll take a while, but there's a shift.
Yeah, and to your credit, you did an interesting deal with a Kenyan-based female founder recently that I found to be very interesting. We had a few questions.
Oh, she's a superstar.
Yeah, superstar. It was great. So I enjoyed reading on that one. We had a few questions come in, but I think we've sort of gone through it all. If anyone has additional questions for Marsha, I believe you left her email in the chain. Igosa, if you would like the audience to reach out to you, I'm happy to share your contact details. As you both mentioned, Marsha, who runs Lofty Inc., has a website where entrepreneurs can get engaged. There's an intake. Well, you're transitioning, right?
That's right.
All right, sorry.
Marsha Wolf does not run Lofty Inc. anymore.
Okay.
I was a co-manager, and I'm retiring and leaving the funds in better hands than it had with me on board.
Congratulations.
And I really am eager to write up our story and help new investors understand the learnings that I had to, learn the hard way.
No, big congratulations on that, and it was great to read recently that your firm was one of the top investors doing one of the top deals in Africa in terms of volume recently. So that was so we really
that just means we invest little amounts in a lot of them, because that gives us more opportunity to find winners. But I would like any help from the audience in terms of finding literary agents or publishers that would be appropriate. Thank you.
Yeah,
or stories. I like stories.
And stories, yeah. And then Igosa, you mentioned as well, your website has an intake form where entrepreneurs who are looking to get funding, who obviously have read your website and Googled what you focus on, can reach out. And then at Stradford Venture Partners, we focus on pharma, fintech, and clean tech. So if you're an entrepreneur, you're interested in that space, or if you are an investor and you would like to invest alongside Stratford or Echo VC or not Marsha, but Lofty Inc., feel free to reach out to all of us. We're all focused on the exact same thing. Well, we're not focused on the exact same thing, but we all have the same passion in direction in the same space. So I want to thank the panelists. Everyone's on mute, so I will clap on behalf of everyone. We really enjoyed it. It was amazing. This is a series, so the next series we'll release details on that coming up forward. We want to provide some more information for the audience members who are very interested in this topic. It was great. Everyone, enjoy the rest of your day or morning or afternoon, wherever you're located. We had a broad audience.
And everyone, I have so enjoyed working with the Stratford team. You're wonderful. I love you. If I were a starting African founder, I would totally come and spend time with you and value your advice. Thank you and best wishes.
Thank you so much.
Thank you. Appreciate it.
Bye,
Take care.